All right, folks, we have some other breaking news today I'm sure you didn't hear about. The U.S. rail traffic surged last week, driven by huge demands for coal, grain, and other. I'm not sure what that is, but it was up double digit. You know, of course, this is not the kind of news that you would expect in this whirlwind of predictions of doom and gloom, but it's not unusual either, right? All this hard data has been pretty good so far. That's why I like the headline note from my next guest, who's talking about the tariff tantrum part of all of this. I'm going to bring in Tristis, their chief economist, Daniel Lacalle. Daniel, let's talk about you put out a lot of work, a lot of great work, and it's sort of it feels to me like a tariff roadmap beginning with the impact of inflation. You know, Jay Powell sort of upset this market about an hour, 40 minutes ago, starting talking about, you know, listen, we know tariffs are typically a one-time bump in inflation, but maybe this time it will have lingering impact. Where are you with respect to the inflation aspect?
Well, thank you very much, Charles. Tariffs don't cause inflation. What causes inflation is massive government spending and money printing. Tariffs don't mean more units of currency in the system. What the market is spooked about, to be fairly honest, is that the Fed is going to make another policy mistake, as it did in September, because it cut rates when it shouldn't have cut rates, because it delayed the reduction of the balance sheet when the economy was already strong. And the economy has been weakening for quite some time. We have seen, for example, with tariffs, that aluminum is down despite the tariffs that have been implemented, and they have been implemented for a while. So I don't see the risk of inflationary pressures. There may be some products that may have some inflationary pressures, but not overall CPI.
All right, so let's talk about negotiations. You're saying negotiations can't be limited to tariff barriers. What do you mean by that?
Yeah, because if you think about it, the problem is not just tariff barriers. The UK, for example, is a country that has very few tariffs. However, it has enormous non-trade, non-tariff barriers. Same happens with the European Union. The European Union has gigantic non-tariff barriers that make it virtually impossible for US exporters to bring their products to the European Union. The Trump administration is right about putting all of that together, because that will be also positive for producers in those countries as well. In the European Union, the ex-president of the European Central Bank was demanding the lifting all of the trade barriers that the European Union had almost a year ago. So non-tariff barriers are enormous and should be eliminated or at least reduced significantly.
All right, and I got to ask, what is the power package?
Well, I think that ultimately what we're going to have is the following. We're going to have one, tax cuts, very important tax cuts, very significant reduction in government spending and efficiency that will, the improvement in efficiency will likely help bring down the deficit. And at the same time, the tariffs implementation and the tariff negotiation is going to bring a tremendous number, a domino of trade deals coming in the next months. So what I think is that in the next months, the pieces of news that are going to appear in the U.S. economy are actually going to be more about the positive effects of tax cuts, of improvement in the public finances, and improvement in the private sector, which is the productive sector.
Bond market turmoil, I got to get your thoughts on this because you've put out a lot of great pieces. We see one hedge fund that's blowing up right now. Everyone kind of sort the basis trade, which, you know, I didn't realize it was $1 trillion trade. So that's starting to unwind. Also, we're seeing maybe signs that it's actually U.S. investors, not foreigners, who've been selling bonds. Where are you with respect to the message from the bond market?
The message from the bond market is very clear. We're living in the hangover of expecting way too much from central banks. Everybody was expecting in the bond market that in 2025 we will have 5, 6 rate cuts. The central banks even implementing quantitative easing. Therefore, lots of investors took the elevated levels of risk on bonds that were hugely expensive and that were already indicating persistent inflation. And therefore, what we're seeing right now is the unwinding of that trade, and that is likely to continue as well as other central banks are reducing their exposure to sovereign debt and increasing their exposure to gold. Those two are elements that should be taken into account.
So I got 10 seconds, Daniel, but I want to squeeze it in because a lot of folks are talking about the end of American exceptionalism. They point to bond turmoil. They point to the dollar, and they're saying, hey, put your money, invest in Europe. You know that better about this better than anyone else. Do you agree?
Well, of course not. Never bet against America. There's absolutely no reason to think that the European Union, which has sent itself into stagnation, is going to lead the world economy in the next few years unless there is some kind of magic wand happening very, very quickly. Never bet for central planning, always bet on innovation and entrepreneurship and the private sector. That is what is going to thrive, and that is what America is going to bring in the next few years.
All right, my man, hold on one second. I'm writing all of that down. Thank you very much. Innovation. Hey, you're the best. Thank you so much. Appreciate it, Daniel.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.